Welcome back to our channel. So Canadian banks have started lowering rates. So in this video, I'm going to share you a strategy to potentially lock in high yields and maybe even some capital gains. Before we get started, if you have been watching our videos, please subscribe. And if you find our content useful, please like and share. So last week, 3 of the top 5 Canadian banks lowered their mortgage rates. Yields across the board have been declining. We feel lending rates and yields have peaked, and we expect the Bank of Canada to start cutting rates in the next 6 months. And now my conviction comes from 5 key macroeconomic factors: cooling inflation, rising unemployment, rising financial instability, rising mortgage costs, and declining consumer confidence levels. We feel these metrics are strong indicators for the Bank of Canada to start cutting rates in the next few months. Alright, so when rates decline, let's see what happens in capital markets. Generally, bonds that give stable distributions, prices of those bonds generally go up, reducing the yields. Now, we feel that by getting in early, you can lock in high yields and maybe enjoy some capital gains. Now, one sector we like in this environment is the Mortgage Investment Corporation space, also known as MICs. Now, MICs are short-term lenders with real estate as collateral. Now, traditional lenders and banks are credit-based lenders, meaning in their loan applications, they are more focused on the credit quality of the borrowers. But MICs, they are asset-based lenders, meaning they are more focused on the quality of the asset or the real estate, more than they focus on the credit quality of their borrowers. Now, MIC loans are generally more riskier than loans given by traditional lenders or banks. So to alleviate this risk, MICs keep a low loan-to-value ratio. For example, MICs have LTVs in the range of 50 to 70%, while banks give loans with loan-to-values of up to 95%. What that means is, in the event of a default and the property comes to a MIC, the real estate prices have to decline by 30 to 40% before the MIC starts to lose capital. With that, let me introduce you to the 2 largest publicly traded MICs in the country. Number 1, Timber Creek Financial. They are the largest MIC in the country with over $1 billion in mortgages. They lend to real estate companies that operate cash-flowing multifamily properties. More than 90% of their mortgages are first mortgages, which means that in the event of a default, they have first priority over anyone else on that property. Now, their LTV, loan-to-value ratio, is less than 70%, which means that property prices have to decline by 30% before Timber Creek starts losing capital on their default loan. Now, this company offers dividends approximately 70 cents per year. Shares are trading at $6.50, reflecting a yield of 11%. Now, 2 years ago, when interest rates were at record lows, shares of this company were 50% higher, about $9.50, and yields were 50% lower, about 7%. So over the next year, if rates continue to decline, we are expecting material capital gains for the stock while locking in 11% yield. My next pick is Atrium Mortgage. They have close to $900 million in mortgages. Now, they lend to condo developers, so their collateral are development/construction projects. More than 95% of their mortgages are first, and their LTV is less than 60%. Now, their loans have higher risk than that of Timber Creek, but their LTV is lower and they have high exposure to first mortgages, and their yield is slightly higher at about 11.5%. Now, Atrium is the highest yielding publicly traded MIC out there. So that's what I have for you today, a potential strategy for locking in high yields. As always, if you like our content, please support us, like, share, and subscribe. Thanks for watching. I'll be back next week with more ideas.